Introduction to tax lien investing. Tax lien investing involves purchasing a lien against a property when the owner fails to pay their property taxes. This investment mechanism is backed by the property itself, offering a secure way for investors to earn interest. When property owners become delinquent on their taxes, local governments place a lien on the property to ensure the collection of unpaid taxes. These liens are then sold to investors, who essentially pay the outstanding tax bill on behalf of the delinquent owner. The primary motivation for governments to sell these liens is to recover lost revenue quickly, allowing them to fund essential public services without delay. For investors, tax liens present an opportunity to earn a high rate of return, often significantly higher than traditional savings or bond investments. Understanding this fundamental concept is the first step towards successful tax lien investing. The process typically begins with a tax sale or auction, where investors bid on these tax liens. Each state and county has specific laws governing these sales, including the interest rates offered and the redemption period. The redemption period is a crucial timeframe during which the property owner can pay back the investor the amount of the lien plus accrued interest. If the property owner redeems the lien, the investor receives their principal back along with the guaranteed interest. Should the owner fail to redeem within the specified period, the investor may have the right to initiate foreclosure proceedings to acquire the property, though this is a less common outcome. This dual potential for high interest or property acquisition makes tax lien investing an attractive, albeit complex field. Understanding tax lien certificates. A tax lien certificate is the official document an investor receives after purchasing a tax lien at an auction. This certificate serves as proof of the investor's claim against the delinquent property owner for the unpaid taxes plus interest. It is not a deed to the property itself, but rather a claim that grants the holder certain rights, primarily the right to collect the outstanding tax debt and any accrued interest. This certificate typically specifies the property address, the amount of the lien, the interest rate, and the redemption period. It is crucial for investors to understand that they are purchasing a debt, not the property directly, at this stage. The value of the certificate is directly tied to the outstanding tax amount and the statutory interest rate. The creation of a tax lien certificate follows a structured process initiated by local government entities. After property taxes become delinquent, the taxing authority will issue a notice to the property owner. If the taxes remain unpaid, the county or municipality will then offer the tax lien for sale, usually through a public auction. Upon a successful bid, the investor pays the delinquent taxes and in return receives the tax lien certificate. This transaction effectively transfers the government's right to collect the taxes and interest to the investor. The certificate must be properly recorded with the county to establish the investor's legal claim, ensuring that their interest is protected and recognized within the legal system. The role of property taxes. Property taxes are a fundamental source of revenue for local governments, funding essential services like schools, police, fire departments, and infrastructure projects. These taxes are typically assessed annually based on the appraised value of real estate within a jurisdiction. The consistent collection of property taxes is vital for the financial stability and operational capacity of cities, counties, and special districts. Without this revenue, local services would suffer, directly impacting the quality of life for residents. Therefore, governments have robust mechanisms in place to ensure these taxes are paid, including the ability to place liens on properties for non-payment. Understanding the critical role of property taxes helps investors appreciate the government's incentive to facilitate tax lien sales. When property owners fail to pay their taxes, it creates a deficit in local government budgets, necessitating a solution. The issuance of tax liens and their subsequent sale to investors is a direct consequence of this need. This system allows governments to recover delinquent tax funds without having to immediately seize and sell properties, which can be a lengthy and costly process. For the property owner, non-payment can lead to significant penalties, interest charges, and ultimately, the risk of losing their property through a tax deed sale if the lien is not redeemed. This highlights the serious implications of neglecting property tax obligations and underscores the security inherent in tax lien investments, as they are backed by the government's authority to collect these essential revenues. Types of tax sales. Understanding the distinction between tax lien sales and tax deed sales is paramount for any aspiring investor. In a tax lien sale, investors purchase the right to collect delinquent property taxes plus interest from the property owner. The investor does not immediately gain ownership of the property. Instead, they hold a lien against it, which acts as a claim. The property owner retains possession and has a redemption period to pay off the lien. This type of sale is common in states like Florida, Arizona, and Maryland, where the focus is on recovering tax revenue while giving owners a chance to rectify their delinquency. The primary goal for the investor is to earn a high rate of interest on their investment. Conversely, a tax deed sale occurs when the property owner fails to pay their taxes for an extended period, and the government decides to sell the property outright to recover the delinquent taxes. In this scenario, the investor purchases the actual deed to the property, gaining immediate ownership upon successful completion of the sale. There is typically no redemption period after a tax deed sale, meaning the buyer acquires the property free and clear of the prior tax debt. States like California, Georgia, and Texas primarily conduct tax deed sales. While tax deed sales offer the potential for acquiring properties at significantly reduced prices, they often come with higher risks, including potential encumbrances or unknown property conditions, requiring more extensive due diligence. Legal framework and regulations. The legal framework governing tax lien and tax deed sales is complex and varies significantly from state to state, and even between counties within a state. Each jurisdiction has its own statutes dictating the procedures for tax delinquency, lien issuance, sale processes, interest rates, and redemption periods. Investors must undertake thorough research into the specific laws of the state and county where they intend to invest. Ignorance of these laws can lead to significant financial losses or legal complications. Key legal aspects include the notice requirements for delinquent property owners, the methods of conducting auctions, and the precise steps an investor must follow to either collect on a lien or initiate foreclosure proceedings. Adhering strictly to these regulations is critical for a successful and legally sound investment. Furthermore, understanding the priority of liens is another vital component of the legal framework. Tax liens typically hold a superior position to most other liens, including mortgages, meaning they must be satisfied first in the event of a sale. This super priority status is a significant factor in the security of tax lien investments. However, there can be exceptions, such as federal tax liens, which may sometimes supersede local tax liens. Investors must also be aware of any potential junior liens that might exist on a property, as these could complicate future foreclosure processes if the tax lien is not redeemed. Consulting with legal professionals specializing in real estate and tax law is often advisable to navigate these intricate legal landscapes effectively and ensure compliance. Benefits of tax lien investing. Tax lien investing offers several compelling benefits that attract a diverse range of investors. One of the most significant advantages is the potential for high interest rates, often ranging from 8% to 36% annually, depending on the state. These rates are typically set by state law and are often much higher than those offered by traditional investment vehicles like savings accounts or bonds. This attractive return potential makes tax liens a powerful tool for portfolio diversification and wealth accumulation. Furthermore, the investment is secured by real estate, providing a tangible asset backing the lien. This inherent security mitigates some of the risks associated with other high-yield investments, offering a level of stability that is highly valued by investors seeking reliable returns. Another key benefit is the relatively low entry barrier, as some tax lien certificates can be purchased for just a few $100s. making it accessible to small investors. This accessibility allows individuals to participate in real estate-backed investments without needing substantial capital. Moreover, the process is often straightforward, especially for those who conduct thorough due diligence and understand the local regulations. The potential for acquiring property at a significant discount if the lien is not redeemed, though a less frequent outcome, adds another layer of appeal. This combination of high interest potential, real estate security, and accessibility makes tax lien investing a unique and potentially lucrative opportunity for informed individuals. Risks and challenges. Despite the attractive benefits, tax lien investing is not without its risks and challenges, which require careful consideration. One primary risk is the redemption period. If the property owner redeems the lien, the investor receives their principal and interest, but loses the opportunity to potentially acquire the property. While this is the most common outcome and still profitable, some investors might be hoping for property acquisition. Another significant challenge is competition at auctions, especially for desirable liens, which can drive up premiums and reduce effective interest rates. Overpaying for a lien can diminish profitability, making strategic bidding crucial. Furthermore, the illiquid nature of tax lien certificates means they cannot be easily converted to cash before the redemption period ends, tying up capital for a specific duration. Due diligence is paramount, but also presents a challenge. Investors must thoroughly research each property to avoid unforeseen issues like environmental hazards, structural damage, or other undisclosed liens that could complicate future foreclosure or property ownership. While tax liens typically have super priority, other liens, such as federal tax liens or certain municipal assessments, can sometimes complicate matters. Additionally, the legal complexities of state and local laws require meticulous attention. Misunderstanding a regulation can lead to costly errors or even invalidate an investment. Navigating these risks effectively requires a disciplined approach, comprehensive research, and a clear understanding of personal investment goals, ensuring that potential rewards outweigh the inherent challenges. Who can invest in tax liens? Tax lien investing is generally accessible to a broad range of individuals and entities, making it a democratic investment opportunity. Most states allow any individual, partnership, corporation, or LLC to participate in tax lien sales, provided they meet basic legal requirements. These requirements typically include being of legal age, having a valid form of identification, and being able to legally enter into contracts. Some jurisdictions may require investors to register with the county or state tax authority before participating in auctions. It is important to verify these specific registration requirements in the target investment area. The relatively low entry cost for many certificates also broadens the investor base, making it feasible for those with limited capital to begin investing. While the general eligibility is broad, successful tax lien investing often requires certain characteristics from the investor. These include a willingness to conduct thorough research and due diligence, a patient approach given the redemption periods, and an understanding of the legal nuances involved. Investors should also possess the financial capacity to hold the investment for the duration of the redemption period without needing immediate liquidity. While professional experience in real estate or finance can be beneficial, it is not a prerequisite. Many successful tax lien investors started with little to no prior experience, learning through dedicated study and practical application. The key is a commitment to education and a methodical approach to identifying and managing investments. Researching tax lien properties. Effective research is the cornerstone of successful tax lien investing, enabling investors to identify profitable opportunities and mitigate risks. The first step involves identifying jurisdictions that conduct tax lien sales and offer favorable interest rates and redemption periods. This often means researching state statutes and county policies. Once a jurisdiction is selected, investors need to access lists of delinquent properties available for sale. These lists are typically published by county tax collectors or treasurer's offices, often weeks or months before an auction. They can be found on county websites, through specialized online platforms or sometimes in local newspapers. Thoroughly reviewing these lists is crucial for initial screening. Beyond the initial lists, detailed property-specific research is essential. This involves examining the property's characteristics, such as its location, size, zoning, and current use. Investors should also investigate the property's market value to ensure the lien amount is a reasonable percentage of the property's worth. Online tools like County GIS, Geographic Information System, maps, property appraiser websites, and real estate listing sites can provide valuable data. Additionally, understanding the demographics and economic health of the area can offer insights into the likelihood of redemption or future property value. This comprehensive approach to research helps investors make informed decisions and avoid undesirable properties. Due diligence process. The due diligence process is arguably the most critical phase in tax lien investing, designed to uncover potential issues that could impact the investment's profitability or legality. This involves a meticulous examination of the property beyond what is initially available on public lists. Investors must verify the accuracy of the tax lien information, including the amount owed and the legal description of the property. A crucial step is to conduct a thorough title search to identify any other existing liens, encumbrances, or ownership disputes. While tax liens often have super priority, understanding all claims against a property is essential, as some, like federal tax liens, can still pose significant challenges. This detailed investigation helps prevent unforeseen complications down the line. Physical inspection of the property, if possible and legally permissible, is also highly recommended. This helps assess the property's condition, identify any environmental hazards, or determine if the property is occupied. Driving by the property can provide valuable insights into the neighborhood, its upkeep, and potential market value. Additionally, investors should research the property owner's history, if publicly available, to gauge the likelihood of redemption. A history of repeated tax delinquency might suggest a higher chance of non-redemption, potentially leading to property acquisition. Conversely, a one-time oversight might indicate a higher probability of redemption. Comprehensive due diligence minimizes risks and maximizes the potential for a successful investment outcome. Understanding redemption periods. The redemption period is a critical component of tax lien investing, representing the time frame during which the delinquent property owner can pay off the tax lien. This period is established by state law and can vary significantly, typically ranging from 6 months to 3 years, or even longer in some jurisdictions. During this time, the property owner must pay the investor the original lien amount, plus all accrued interest and any statutory penalties or fees. The purpose of the redemption period is to give property owners a final opportunity to retain their property by satisfying their tax obligations. For investors, understanding the length and specific rules of the redemption period is paramount, as it dictates how long their capital will be tied up and when they can expect a return or potentially acquire the property. If the property owner successfully redeems the lien within the specified period, the investor receives their principal investment back along with the statutory interest earned. This is the most common outcome and represents a profitable return on investment. However, if the property owner fails to redeem the lien by the end of the redemption period, the investor may then have the right to initiate foreclosure proceedings to acquire the property. The exact steps for foreclosure also vary by state and can be complex, often requiring legal assistance. It is crucial for investors to track redemption deadlines meticulously and understand the specific procedures for non-redemption in their chosen jurisdiction. This foresight ensures investors are prepared for either outcome and can act promptly to protect their investment. Calculating potential returns is a fundamental skill for tax lien investors, allowing them to assess the profitability of an investment before committing capital. The primary component of return is the statutory interest rate, which is fixed by state law and can range significantly, often from 8% to 36% annually. This rate is applied to the original lien amount. Investors must also account for any premiums paid at auction. If an investor bids a premium above the lien amount, that premium is typically not returned upon redemption, effectively reducing the overall yield. Therefore, the true yield is often lower than the stated interest rate, especially if a significant premium is paid. Understanding this distinction is crucial for accurate return calculations. Beyond the statutory interest, some jurisdictions may allow investors to recover certain fees and penalties incurred during the process, such as legal fees for foreclosure or subsequent tax payments made by the investor. These additional recoveries can further enhance the overall return. However, it is essential to verify which fees are recoverable in the specific jurisdiction. Investors should also consider the duration of the redemption period. A longer period means capital is tied up for a longer time, impacting the annualized return. Using spreadsheets or specialized software to model different scenarios, including various redemption times and premium payments, can help investors accurately project their potential profits and make informed bidding decisions at auctions. Participating in tax lien auctions is the direct pathway to acquiring tax lien certificates, and understanding the different formats is crucial. Auctions can be held either online or in person, with each format presenting its own set of advantages and challenges. Online auctions have become increasingly popular, offering convenience and broader accessibility, allowing investors to bid from anywhere with an internet connection. These platforms often provide detailed property information and automated bidding systems. However, online auctions can also be highly competitive, requiring quick decision-making and a solid bidding strategy. Familiarity with the specific online platform's interface and rules is essential to avoid errors. In-person auctions, while less common now, still occur in some jurisdictions and offer a different experience. They provide an opportunity for investors to observe the competition directly and potentially engage in more strategic, nuanced bidding. Attending in-person auctions can also facilitate networking with other investors and local officials, which can be valuable. However, they require physical presence and can be more time-consuming. Regardless of the format, developing a clear bidding strategy beforehand is paramount. This includes setting maximum bid limits for each lien, understanding the premium bidding versus interest rate bidding mechanics, and remaining disciplined to avoid emotional overbidding. A well-prepared investor approaches auctions with a clear plan and adheres to their research-backed valuations. The bidding process explained. The bidding process at tax lien auctions can take several forms, primarily revolving around either premium bids or interest rate bids. In premium bidding states, investors bid on the amount they are willing to pay above the actual tax lien amount. The investor who bids the highest premium wins the lien. For example, if a lien is for $1,000 and an investor bids a $100 premium, they pay $1,100. Upon redemption, the property owner pays back the original $1,000 plus interest, but the $100 premium is typically not returned to the investor. This means the premium effectively reduces the investor's overall yield, making it crucial to calculate the true effective interest rate before bidding. Premium bidding is common in states like Florida and Arizona. Conversely, in interest rate bidding states, investors bid down the statutory interest rate. The auction starts at the maximum allowable interest rate, and investors bid successively lower rates until the lowest bid wins. For example, if the statutory rate is 18%, bidders might start at 18% and bid down to 16%, then 14%, and so on. The investor who bids the lowest interest rate wins the lien. Upon redemption, the property owner pays the original lien amount plus the winning lower interest rate. This method ensures the investor receives their principal back along with the agreed-upon interest. States like Colorado and Illinois often use interest rate bidding. Understanding which bidding method is employed in a specific jurisdiction is fundamental to formulating an effective and profitable auction strategy. Acquiring a tax lien certificate. Once an investor successfully bids on a tax lien at an auction, the next crucial step is the formal acquisition of the tax lien certificate. This process typically involves completing specific paperwork and paying the winning bid amount to the county or municipal tax authority. The payment must usually be made within a short time frame, often within 24 to 48 hours of the auction, to finalize the purchase. Failure to make timely payment can result in forfeiture of the winning bid and potential penalties. Upon successful payment, the tax authority will issue the official tax lien certificate, which is the legal document proving the investor's claim against the property. After receiving the tax lien certificate, it is imperative for the investor to ensure it is properly recorded with the County Recorder's Office or equivalent Land Records Department. Recording the certificate establishes a public record of the investor's lien against the property, protecting their interest and providing legal notice to all other parties. This step is critical because an unrecorded lien may not be enforceable or recognized in a court of law. The certificate should contain all pertinent information, including the property's legal description, the amount of the lien, the interest rate, and the date of sale. Meticulous attention to these administrative details ensures the investor's rights are fully secured and legally recognized throughout the redemption period and beyond. Managing your tax lien portfolio. Effective management of a tax lien portfolio is essential for maximizing returns and minimizing risks. Once multiple tax lien certificates are acquired, investors need a systematic approach to track each investment. This includes maintaining detailed records of each certificate, noting the property address, lien amount, interest rate, purchase date, and most importantly, the redemption period expiration date. Using spreadsheets, specialized software, or even dedicated online platforms can help organize this information efficiently. Regular monitoring of these dates is critical to ensure no redemption deadlines are missed, which could impact the ability to initiate foreclosure if necessary. Proactive management allows investors to stay informed and ready to act on each lien. Beyond tracking dates, portfolio management also involves monitoring the status of the underlying properties. This might include periodically checking for changes in property ownership, new tax delinquencies, or any other events that could affect the lien's value or the likelihood of redemption. Some investors choose to pay subsequent property taxes on the liened property to protect their investment, as these payments can often be added to the lien amount and recovered upon redemption. This strategy ensures the lien maintains its priority and prevents other parties from acquiring new liens. Regular review of the overall portfolio performance, including actual versus projected returns, helps in refining investment strategies and making informed decisions for future acquisitions. Foreclosure process, if not redeemed. If a tax lien certificate is not redeemed by the property owner within the statutory redemption period, the investor typically gains the right to initiate foreclosure proceedings to acquire the property. This process is highly legalistic and varies significantly by state, often requiring the assistance of an attorney specializing in real estate law. The first step usually involves sending formal notice to all interested parties, including the property owner, mortgage holders, and any other lien holders, informing them of the intent to foreclose. This notice serves to ensure due process and provide a final opportunity for redemption. Strict adherence to legal timelines and notification requirements is paramount to avoid jeopardizing the foreclosure action. The foreclosure process can culminate in a court order granting the investor a tax deed which transfers ownership of the property. However, this path can be lengthy, costly, and complex, involving court filings, hearings, and potentially dealing with existing occupants or other legal challenges. Investors must be prepared for these potential expenses and delays. In some jurisdictions, a judicial foreclosure is required, meaning a court must approve the transfer of title. In others, a non-judicial process might be available, which can be faster but still requires meticulous legal compliance. Understanding the specific foreclosure laws of the jurisdiction where the lien is held is absolutely essential for any investor considering this route, as it represents a significant commitment of time and resources beyond the initial lien purchase. Understanding tax deeds. A tax deed represents direct ownership of a property that has been foreclosed upon due to unpaid property taxes. Unlike a tax lien certificate, which is a claim against a property, a tax deed is the actual title to the real estate. When a property owner fails to redeem a tax lien within the statutory period, or if the jurisdiction conducts direct tax deed sales, the government can sell the property outright. The purchaser of a tax deed acquires the property free and clear of most prior liens, including mortgages, making it a powerful way to obtain real estate at a potentially significant discount. This direct acquisition of property is a key differentiator from tax lien investing, where the primary goal is interest income. The process for acquiring a tax deed typically involves a public auction, where the property is sold to the highest bidder. The minimum bid often covers the outstanding taxes, penalties, and administrative costs. While tax deeds offer the potential for substantial profits through property acquisition, they also carry higher risks. Investors must conduct even more rigorous due diligence to ensure a clear title and assess the property's condition. As there is usually no redemption period after a tax deed sale, any existing encumbrances not extinguished by the tax deed process or unknown property defects become the responsibility of the new owner. Understanding these nuances is crucial for investors considering the tax deed route, as it requires a different level of risk assessment and property management expertise. Selling a tax lien certificate. While most investors hold tax lien certificates until redemption or foreclosure, it is possible to sell or assign a certificate to another investor before the redemption period ends. This can be a viable exit strategy for investors who need to free up capital sooner than anticipated, or who wish to divest from a particular investment. The ability to sell a tax lien certificate depends on state and local regulations, as some jurisdictions have specific rules regarding assignment. Typically, the original investor can sell their interest in the lien to a new investor, who then assumes all rights and responsibilities associated with the certificate. This secondary market for tax liens provides a degree of liquidity that might otherwise be absent. The process of selling a tax lien certificate usually involves a formal assignment document, which legally transfers the ownership of the certificate. This document must be properly executed and often recorded with the county to ensure the transfer is legally recognized. The sale price of a tax lien certificate in a secondary market is negotiable and will depend on several factors, including the remaining time in the redemption period, the interest rate, the property's value, and the overall demand for tax liens. Investors looking to sell should be prepared to potentially offer a discount to attract buyers, especially if the redemption period is nearing its end or if the lien carries higher perceived risks. Conversely, a lien with a long redemption period and a high interest rate might command a premium. Understanding this secondary market can provide flexibility in managing a tax lien portfolio. Tax implications of investing. Understanding the tax implications of tax lien investing is crucial for accurate financial planning and compliance. The interest earned from tax lien certificates is generally considered taxable income. This income is typically treated as ordinary interest income, similar to interest earned from a savings account or bonds, and is subject to federal, state, and local income taxes. Investors should keep meticulous records of all interest received and consult with a tax professional to ensure proper reporting. The timing of when this income is recognized can also vary. Some jurisdictions may consider the interest taxable when it is earned, while others may consider it taxable only when the lien is redeemed. Clarifying these specifics with a tax advisor is highly recommended. If a tax lien is not redeemed, and the investor acquires the property through foreclosure, there are additional tax considerations. The acquisition of the property itself does not immediately trigger a taxable event, but the basis of the property for capital gains purposes will be the amount paid for the lien, plus any subsequent taxes paid and foreclosure costs. If the investor later sells the acquired property, any profit realized from the sale will be subject to capital gains tax. The holding period of the property will determine whether it is treated as a short-term or long-term capital gain, influencing the applicable tax rate. Furthermore, if the investor intends to rent out the property, they will incur rental income, which is also taxable and may be eligible for various deductions. Comprehensive tax planning is essential to optimize returns and avoid unexpected liabilities. Advanced strategies. Bulk purchasing. Bulk purchasing of tax lien certificates is an advanced strategy employed by experienced investors to scale their operations and potentially increase their overall returns. Instead of bidding on individual liens, investors acquire a portfolio of multiple liens, often at a discount, from a county or another investor. This approach can significantly reduce the per lien acquisition cost and streamline the investment process. Counties sometimes offer bulk sales of less desirable or smaller liens that did not sell at initial auctions, providing an opportunity for investors to acquire a large volume of certificates. Bulk purchasing can also be done through specialized brokers or online platforms that aggregate liens from various jurisdictions. While bulk purchasing offers efficiency and potential cost savings, it also comes with its own set of considerations. The due diligence process for a large portfolio of liens can be daunting, requiring sophisticated tools and processes to quickly assess the value and risks of numerous properties. Investors must be prepared to handle a higher volume of administrative tasks, including tracking multiple redemption dates and managing diverse property statuses. The overall risk is diversified across many liens, but a single significant issue within the portfolio could still impact returns. This strategy is best suited for investors with substantial capital, robust organizational skills, and a deep understanding of the tax lien market, allowing them to leverage economies of scale effectively. Advanced strategies. Over-the-counter liens. Over-the-counter (OTC) tax liens represent another advanced strategy for investors seeking opportunities outside of competitive auctions. These are tax lien certificates that were offered at a public auction but did not sell, often because there were no bidders or the minimum bid was not met. After the auction, many counties make these unsold liens available for purchase directly from the tax collector's office. On a first-come, first-served basis, OTC liens often come with the statutory interest rate, without the need to pay a premium or bid down the interest. This can make them highly attractive, as investors can acquire liens at face value and still earn a guaranteed high rate of return, avoiding the intense competition of live auctions. Finding and acquiring OTC liens requires proactive research and consistent monitoring of county websites or direct communication with tax offices. Investors need to identify jurisdictions that offer OTC sales and regularly check their lists of available liens. While OTC liens can offer excellent value, they may also represent properties that were deemed less desirable by other investors, possibly due to lower property values, longer redemption periods, or other perceived risks. Therefore, thorough due diligence remains paramount, even for OTC acquisitions. Investors should carefully evaluate each property to ensure it aligns with their investment criteria and risk tolerance. This strategy is particularly beneficial for investors who prefer a less competitive environment and are willing to put in the effort to uncover these hidden opportunities. Common mistakes to avoid. Avoiding common pitfalls is as important as understanding successful strategies in tax lien investing. One of the most frequent mistakes is insufficient due diligence. Rushing into an investment without thoroughly researching the property, its value, and any existing encumbrances can lead to acquiring a lien on a property with significant hidden issues, ultimately eroding profitability. Another common error is emotional bidding at auctions, where investors get caught up in the competitive atmosphere and overpay for a lien, either through excessive premiums or by bidding down the interest rate too low. This can drastically reduce the effective yield and make the investment less attractive than initially perceived. Discipline and adherence to predetermined maximum bids are crucial. Ignoring state and local laws is another critical mistake. The legal landscape for tax liens is highly jurisdiction-specific, and misunderstanding redemption periods, notification requirements, or foreclosure procedures can invalidate an investment or lead to costly legal battles. Investors must commit to continuous learning and, when in doubt, seek professional legal advice. Furthermore, failing to properly track and manage a portfolio of liens can result in missed redemption deadlines or overlooked opportunities to initiate foreclosure. This administrative oversight can be particularly detrimental for investors with multiple certificates. By being aware of these common mistakes and actively working to avoid them, investors can significantly improve their chances of success and protect their capital in the tax lien market. Building a network. Building a robust network is an invaluable asset for any tax lien investor, offering access to shared knowledge, mentorship, and potential collaboration opportunities. Connecting with other experienced tax lien investors can provide insights into different strategies, market trends, and jurisdictional nuances that might not be readily available through public resources. These connections can offer practical advice, share lessons learned from their successes and failures, and even identify potential investment partners. Attending industry conferences, workshops, and local investor meetups are excellent ways to forge these relationships. Online forums and social media groups dedicated to tax lien investing also provide platforms for networking and information exchange, fostering a sense of community among investors. Beyond fellow investors, it is equally important to build relationships with key professionals who can support your investment activities. This includes real estate attorneys specializing in tax sales and property law, who can provide crucial legal guidance and assist with foreclosure proceedings. Tax accountants are essential for navigating the complex tax implications of your investments. Local county tax officials can be a valuable source of information regarding auction schedules, property lists, and specific local procedures. Additionally, real estate agents and property managers can offer insights into local market conditions and assist with property disposition if you acquire a tax deed. A strong network of both peers and professionals significantly enhances an investor's ability to navigate the complexities of the tax lien market successfully. Exit strategies. Having well-defined exit strategies is crucial for successful tax lien investing, as it dictates how and when you realize your returns. The most common exit strategy is redemption, where the property owner pays off the lien plus accrued interest within the statutory redemption period. In this scenario, the investor receives their principal back along with a profitable interest payment, and the investment cycle for that particular lien concludes. This is often the desired outcome for many tax lien investors, as it provides a predictable and high-yield return without the complexities of property ownership. Investors should always be prepared for redemption as the primary outcome, as it accounts for the vast majority of tax lien investments. If the property owner fails to redeem the lien, the investor then has the option to pursue foreclosure, leading to the acquisition of the property through a tax deed. This represents a different exit strategy, where the goal shifts from earning interest to obtaining real estate. Once the property is acquired, the investor can then choose to sell it for a profit, rent it out for passive income, or develop it for a higher return. Each of these options requires additional capital, time, and expertise. Alternatively, an investor might choose to sell or assign their tax lien certificate to another investor before the redemption period ends, providing an earlier exit and freeing up capital. This secondary market option offers flexibility, especially if an investor needs liquidity or wishes to reallocate funds to other opportunities. Clearly defining preferred exit strategies for each investment helps in making informed decisions throughout the lien's lifecycle. Conclusion and next steps. This course has provided a comprehensive overview of tax lien property investments, covering everything from fundamental concepts to advanced strategies and risk management. We have explored the legal frameworks, the critical due diligence process, and the various methods of acquiring and managing tax lien certificates. Understanding the distinction between tax lien and tax deed sales, calculating potential returns, and navigating the bidding process are all essential skills for success in this niche market. The importance of meticulous record-keeping, continuous learning, and building a strong network of professionals cannot be overstated. Tax lien investing offers unique opportunities for high returns and real estate-backed security, but it demands a disciplined, informed, and patient approach. As you conclude this diploma, your next steps should focus on practical application and continued education. Begin by selecting a specific jurisdiction for your initial investments and thoroughly researching its unique laws and procedures. Start with smaller, less complex liens to gain experience and confidence. Consider attending local tax sales, even if only to observe, to familiarize yourself with the auction environment. Continuously expand your knowledge through industry publications, online resources, and networking with experienced investors. Remember that successful tax lien investing is a journey of continuous learning and adaptation. With a solid foundation and a commitment to ongoing development, you are well equipped to pursue profitable opportunities in this dynamic investment field.